Okay, lads, so continuing on from where we left off, we're moving on to credit sales and I suppose the treatment of GST when we're talking about credit sales. So as we know that a credit transaction effectively separates a sale into two transactions. So the first one we've got is the actual exchange of goods. And the second is essentially only the exchange of cash at some later date. So the important thing is to work out when we need to account for the GST. And this is basically the sentence we're looking at here. So when the stock is sold on credit and the goods are exchanged, the source document will be a sales invoice. The GST is then recognised and reported at the time of the sale. So the invoice must show all the necessary information, all the information necessary for it to be classified as a tax invoice. I suppose the thing that kind of stumps people with dealing with credit transactions and GST is that the person, our customer owes us the whole amount. So it's the sale price and the amount of GST. Just because they're paying at a later date doesn't mean that they don't have to pay the GST. So if we have a look here, we've got a sales invoice, obviously from Snap Photographic Equipment, because obviously the name of the seller always appears on the top of the invoice. We've got a customer here. It's been sold to A. Windley or Windley. They've sold 5 Minolta cameras, unit price $400. So we've got a total amount of $2,000 as a selling price. And we've got a GST amount of $200 there. So selling price in green, GST there in blue. Now notice there that the cost price of the sale isn't shown on the invoice, but we know that obviously we will have been told how we can calculate the cost price of the sale. So if we have a look here, as I suppose we were sort of talking about today, except we were talking about cash transactions. So the only difference really is that this debtor's control is where I suppose the asset is realised for $2,200, and then we've got it split out, 2,000 as credit sales and 200 as GST clearing. Now, boys, we had a little bit of trouble with this today. So what I want you to do is I want you to pause it and rewind it so that we can and just make sure that we've got this item or this area cemented in our heads. Okay, so notice here when we put it to the ledger, we've got a split cross-reference here. So part of this transaction is going to go to sales, and part of this transaction is going to go to GST clearing, and we can see that down here. So there's the other half of that transaction. And then we've got the GST clearing here as well. Okay, credit purchases. So when goods are purchased on credit, the supplier will issue what we call a purchase invoice. Now, a purchase invoice is going to look really a lot like a sales invoice, except it's going to be from a different perspective. So instead of our client or our business issuing the purchase invoice, it will be the customer. It will be the supplier that's issuing that to us. So So if we have a look at figure 4.13, our client will be Snap's photographic equipment. Snap's photographic equipment, and their supplier will be Pentax. So this will be the name of the creditor, and this is our client. Now again, what we've got to remember with this is that GST will not add to the value of the asset. So we've purchased the asset, which is the stock. It's worth $2,700, and the GST, which I'll put in blue, is totally separate and will not add to the value of the asset. However, it will add to the value of the liability because we still have to pay that GST. I'm going to reiterate this because this is really important. GST does not add to the value of an asset. Okay, so notice here again, we've got a cross-reference that is a split cross-reference. So this transaction is actually getting split here and up to here. Just to summarize, there is actually a really good summary here. So the GST clearing account shows these four things. GST received on cash sales, GST charged to debtors on credit sales. It'll show the GST paid on cash purchases, and it'll show the GST charged by creditors on credit purchases. So this is the situation that we're aiming for. We want the GST on sales to be greater than GST on purchases. So in this case, GST will have a credit balance, which means that it will be reported as a current liability. Although it means that we will have to pay that money, or a payment will need to be made to the ATO, called a GST settlement, it means that we're making more money, we're receiving more money than we are paying out, which is obviously a good thing. That means our business is turning a profit, which is obviously the name of the game. All right, boys, we're going to have to do some review questions. I think we need to do review questions 4.5, all of them, and 4.6. See you tomorrow.